For most of 2024, the number one word on the lips of analysts, strategists, and market pundits was breadth. Market breadth was markedly poor leading up into this week, with technology and communication services driving the majority of the gains in the market. But that all changed on Thursday after a cool CPI report saw big tech tumble and the broad market gain in what marked a violent breadth rotation. So where do we go from here, and what signals should we look for in this market rotation that's either going to signal to us a continuation or a breakdown of the current market trend? Today, we're diving into all of that and also discussing earnings and data in the week ahead, sentiment, and of course, market valuation. Where exactly can we find value in light of recent market momentum, and what will come of the Magnificent Seven? We've got a lot to talk about. Let's roll the tape. Welcome everybody to a special weekend edition of the show. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the weekly heat map of the S&P 500, the last 5 days of trade, and you obviously see a lot of green, but red in certain places. Comm services didn't do so well. My portfolio was down on the week because my biggest position is Meta, down 7.6% right here. Google, not quite as bad as Meta, but down 2.7%. Same here with Amazon, Tesla, as well as Microsoft. But Tesla actually holding in there, down 1.31% for the week, but actually down 8% on Thursday after the robotaxi news. So a very resilient stock at the moment. So Visa and MasterCard on some banking regulation news fall, and then the bigger names in software application followed infrastructure tech to the downside. Other than that, guys, a very green day across the board. Quickly, very interesting, CMG Chipotle down 8% for the week, but green everywhere else. I mean, industrials, utilities, real estate, especially healthcare. It was a very green day across the board, excluding communication services and software. Green everywhere. I mean, even Staples was up 0.09%, which tells us it was really just a week for buying stocks. Great breadth rotation, great market rotation. The best stocks were obviously stocks tied to rates. We saw home construction up here. Real estate up 4.41%. Regional banks, we do know why they're tied to rates, because of the loans they have, the bonds they have, the loan losses they have. And then GDX, gold does well in an environment where easier monetary policy persists. Essentially, you're devaluing a currency. Gold is a hedge against currency. We saw GDX do really well. Silver miners would be up here too. XME, the metal sector, XLB, the material sector, up 2.96, 3.84 respectively. It was a very good week for stocks tied to rates, rate cuts, interest rates, but a very good week for stocks nonetheless. Technology didn't do so well. It really was a market rotation into every other sector. XLE up 0.4%, still positive on the week. Semiconductors up 1.75%. The discretionary space up 1.16%. For the S&P 500 to return 0.87% here for the week. And that's taken into consideration that we had like a 1% down day on Thursday. The Nasdaq 100, which holds most of these tech stocks, actually down 0.30%. It just goes to show the strength of these stocks, considering the massive move down we saw here on Thursday. You know, the Nasdaq was down 2.24% on Thursday. To actually see it finish slightly lower is actually kind of crazy. But best performing sector by far, the IWM, small caps, micro caps, mid caps here with the RSP up 2.96%. The Dow Jones in a third place, but it wasn't even close. It was the equal weight S&P 500. It was small caps, it was mid caps. They were the real outperformers. Anything that wasn't the mega caps or the larger stocks in each sector, they really outperformed this week. They did really well, and it all stemmed on Thursday with the CPI report. You can see, look at this gap up here in the IWM, a massive rally in small caps, the RSP, the Dow Jones as well. The S&P 500 was kind of flat. It did par a lot of its losses late Thursday into Friday, and then we saw a broad-based risk-off move towards the end of the week here on Friday. I think this is just people going into the weekend saying, hey, this was such a volatile week in large caps, in the market as a whole, to the upside and the downside. We just maybe want to take some of the gains we've got in the RSP, in the IWM, and that's why we saw the move down here late Friday. But all in all, a very good day for smalls, a very good day for the broad market. Not that great for tech, not as bad as you would think based on Thursday's price action. And that's why market sentiment this week actually ticked up despite what we saw in tech. The BofA bull bear indicator rose to 6.3 from the 6.1 level, and we're finally getting into this territory here. I think anything beyond the 6.5 level is where we really start to go, hey, things are getting a bit frothy right now, but we want to see a push to the 6.5 into the 7 area, and that's going to come as a result of market momentum and market breadth improvement. At the same time, the Goldman Sachs sentiment indicator in stretch positioning at the 1 position, but sort of hovering around this 1.1, 1.2, 1.3 area, and it has seen downward momentum in recent weeks and didn't tick up in the same way that the BofA bull bear indicator did. Either way, both of these indicators are telling us to hold the equities we currently have. If you're in tech, the RSP, the IWM, you want to hold that because more gains can persist, particularly if we do get the breadth improvements we're expecting. We'll see the Goldman Sachs indicator bump up to some of the highs we saw right here over the next couple of weeks, and we'll see this push to as far as the 7, potentially the 8 region near the sell zone. So hold the stocks you do have. These indicators are telling us that markets can actually go higher. But looking at a couple of other sentiment indicators from BofA, this is literally just a bunch of surveys that they do, and they asked credit investors, what are your biggest concerns? The US election was the #1 concern, followed by geopolitical risk and then US fiscal policy. So the US election was the biggest risk. BofA then asked, what impact do you expect from the 2024 election? 32% expected an impact on spreads, but we're not sure if the impact would be positive or negative. 28% expected a negative impact, and 4% expected a positive impact on spreads, which is very, very interesting. So you can see here, US elections will be negative for credit spreads. That's a bad thing, 28%. And so of this number right here, which can cause serious harm in the equity markets, when do they expect that impact to occur? 45% of those investors expect the impact on credit spreads to occur between September and October 2024. The election occurs on the 5th of November. So if we are to see market volatility, we might not get it this month, we might not get it next month, but anywhere from September into October, potentially into as early as November, we might see a significant impact on credit spreads that may blast to the upside. But in the year and now, credit spreads look really, really good. Investment grade credit spreads trading at all-time lows if we look at relative history. Same with high yield spreads. And this is Goldman's expectation. They do expect spreads to increase ever so slightly into 2025, but to still remain at historic lows. And the same is true here for high yield. They actually expect it to go lower. Right now sitting at 308 basis points. It should be at about 90 basis points. And this is pretty much telling us investors are confident in the issuer's ability, whether investment grade issuers or high yield issuers. They're confident in their ability to meet its debt obligations and are willing to accept a lower yield. This is literally what this is telling us. And all in all, this tells us that the perceived risk in the economy, in the market, in stocks is actually not that high, and that investors are demanding a relatively low extra return to take on credit risk, implying a low perceived risk, a high demand for credit, easy credit conditions, easier financial conditions, and all in all, just investor complacency. Whenever credit spreads have been tight, it's been a great time to own equities, so buy equities. So in today's weekly video, we're going to look at the IWM. In yesterday's video, we tackled the S&P 500. Today, we're going to look at small caps, the Russell 2000, and very, very interesting developments. Now, everybody wants back in on small caps after this huge weekly candle, breaking above the highs we made here in early 2024. This is a new 52-week high for the IWM. It looks very, very strong, and it looks like it wants to go take out some of the highs right here. Now, if you've been part of my community for a while, when we were very, very small, less than 1,000 subscribers right here in late 2023, I said it's time to buy small caps. It's time to get long the IWM. It was exactly at the 169 level. This was the tweet right here on the 14th of November. I said, small and mid caps are about to catch an end of year bid, deeply undervalued relative to peers. Time to play catch up. Russell 2000 to 212, now 169. And this is where we are right now in the IWM. We're at the 213 level, so pretty much at the target of the tweet. So where does the IWM go next? Well, let's actually break it down a little bit further. So we can see some very, very clear levels here in the IWM. The first is the 197 level. You can call it 200. It's a very key level because we used it as resistance right here, right here, right here. And then we did actually attempt to break above it. We did fail and then break above it again, fail again. And now we're actually making the move. So we can clearly see that this 197 level was a strong resistance zone. We did get quite a lot of fake outs on the weekly chart, but we are moving up and away, and we've actually made a new 52-week high while actually making higher highs and higher lows at the same time. You can see we put in a low, higher low, higher low, higher low, and now 52-week high, while also breaking highs we made right here, here, and here. Very strong price action in the IWM. If we pull up what the charts look like in the last year, you can clearly see that is a new 52-week closing high for the IWM. This is the 1-year chart. But going back to the weekly chart in the IWM, you can see that we actually are starting to break out of this corrective phase we've been in small caps, and this opens up some other key areas above the 230 level and the 240 level, new all-time high. So what are my expectations for small caps? Well, I think that if we are to pull back, we could go down to as far as the 208 level, but I do think that any pullbacks are going to be very short-lived, and we're just going to continue to make new 52-week highs in the IWM. Our obvious upside targets are the very first one, 226, 235, and then all-time highs 244. And if we actually dive into the daily chart, things look a lot more constructive. You can see that here we broke out above this level. Again, if we are to pull back, resistance turns into support. We should find support at the 208 level and move higher, but I do think that we're probably going to gap up on the open on Monday, and I think we're just going to continue the rally in the IWM. This looks very, very strong. Now, we are slightly overbought if we pull out the stuff like the RSI, so maybe on Monday we can actually see a bit of a pullback, maybe just like a little bit of a gap down, price discovery, work off some of these overbought conditions on the daily, and then move higher. That is completely normal, but I do expect 208 to be the support level, and then for us to move onward and upward, but particularly with the inflation data we just got. And in the week coming up, where we get very limited macro data, we only have retail sales, stocks tend to do very, very well. There's minimal volatility, and I think smalls are going to be a big beneficiary of that. Now, another index that I really like is the CAF index. Now, this is not even overbought yet, and it's gone on quite the rally. Now, year to date, this has been a bit of a dumpster fire. I did put a tweet out right here. I said small cap quality has been hammered this year, but the melt up is imminent. I expect an explosive rally in all small factors driven by earnings growth, margin expansion, breadth improvement, and attractive valuation metrics. The CAF index to 50, IWM to 235. At the time of posting, the CAF index was $42.50. This was the day before we had that explosive move up in small caps. And these are my targets. So IWM to 235, CAF to 50, and that would still be 10 to 12% upside from here. And in the IWM, to get to the 235 area, it would be another 10% move higher in the IWM. So that is exactly what I see. I think we're going to have a minor pullback at the start of the week to as far as the 208 level. But from there, we should bounce, find support, and then continue making new 52-week highs to take us to the 235 area, and honestly onward and upward to new all-time highs. We should see the same in small cap quality, and even stuff like the RSP and mid caps. They should go back to all-time highs 170. Maybe we could see upside targets of 175 in the broader market. And honestly, I think stuff like the S&P 500, we'll see modest gains in the S&P 500. In the Nasdaq, we probably trade sideways. I think 20,000, maybe this 21,000 should be the ceiling for now. So we should see sideways mega caps. The rest of the market should trade upward in what's going to be a huge improvement in market breadth over the next couple of weeks. Q2 earnings season really kicks off this week. We got a lot of stocks reporting earnings, a lot of big names, a lot of names that are going to make headlines. And we start off here on Monday with a lot of the financial names: Goldman, BlackRock, First Bank. And then we continue the trend in financials on Tuesday with Bank of America, Interactive Brokers, Progressive, Morgan Stanley, Charles Schwab. But we also have United Healthcare Group in the healthcare sector. That's really going to move the market. Then on Thursday, we have ASML, United Airlines. Those are the big names, but also Discover Financial, Johnson & Johnson, Ally Bank, US Bank Corp. On Thursday, TSMC and Netflix are going to be the two big hitters that are going to report. Big for semis, big for comm services, big for tech stocks, and then American Express here on Friday. So every single day this week, we have big hitters. We're going to cover all of them in the daily recap show. So guys, go ahead and subscribe so you don't miss a beat. We're going to cover all of these earnings in depth, because that's what we do on this channel. But how is Q2 tracking for the S&P 500? Yesterday, we looked at the Russell 2000, the RTY. So go ahead and check out yesterday's video if you want the full earnings recap on the Russell. This is blended earnings growth for the S&P 500, however. And right now, earnings are looking very, very good. On the revenue side, 4.5% so far. Now, do take into consideration Only 27 companies have reported. This is blended earnings growth, however. And on the earnings side, 9.6%. This compares to the start of earnings season of 4.6 and 8.8. So a little weak on the revenue side, stronger on the earnings side, and margins unchanged at the moment, sitting at 11.8%. But what's very, very interesting, of the 27 companies that have reported earnings in the S&P 500, 81.5 have beat analyst expectations. This compares to the long-term average of 66%. So things looking really good so far for earnings, but it is early days. After this week and maybe the week after next, we'll really get the full picture as to where we're going to go with earnings. Are we going to beat? Are we going to miss? Right now, when it comes to earnings season, earnings takes precedent over any type of macro event in the market right now. So we are in the thick of it, guys. So be prepared for volatility. Now, where does that leave us with valuation? Right now, the S&P 500 sits at 21.6 times. And if you actually look at the median Z-score, that's 1.6 times above its historical average. So the S&P 500 looking relatively expensive, a 3.1% free cash flow yield, 16.2 EV to EBITDA, EV to sales, not too bad, but still pretty pricey, and then a PEG of 1.3 times. So you look at this and the S&P 500 looks relatively expensive compared to history, but then you actually dive into the details and look at each sector individually. The only sector that's overvalued is the tech sector. Now, we do know that the tech sector has the largest market cap names. The tech sector is 1.8 times more expensive than its historical average. Every other sector is actually below its historical average. In other words, you can go buy the entire utility sector, the entire comm services sector, the entire financial sector, and you'd actually be buying it cheaper to its historical valuation. So I think stocks as a whole are looking very attractive. Just in aggregate, tech is really making the S&P 500 look unattractive right now. But this is where the growth is. I mean, look at the PEG of Infotech, 1.5. Not that great, but compared to something like real estate at 5.2, the lower the better. So it's really a balancing act. You do want to own information technology. If you haven't owned tech stocks in the last couple of years, you've underperformed the market for sure. That being said, I think equities are attractive, not just in the US, but around the world. So you definitely want to hold equities right now. And we're seeing a broad-based rally. If you buy these stocks right here, they're going to outperform in the next 3 to 6 months, particularly stuff like comm services, real estate, financials, industrials. I think they're going to do very well, especially if we do get the rate cuts. We're expecting anywhere from 25 to 50 basis points worth of rate cuts. If we get that, you're going to see every other sector perform very, very well, and even maybe outperform the tech sector, which has done very well in the last couple of years. But looking at market breadth, we can see this is the S&P 1500 new highs dashboard, and all of this green is really, really good. You can see stuff in the S&P 500. 59% of companies are at 10-day highs, 41% at 20-day highs, and this is where it starts. It starts at 10-day highs, moves into 20-day highs, and what we really want to see over the next couple of weeks is into 3-month, 6 months, and 12-month highs. We're already starting to see that in financial stocks, and there's green across the board, which means market breadth is improving. You looked at this chart just a couple of months ago and it was green in tech, white everywhere else. Now it's green across the board. This is very, very healthy market breadth, healthy market improvement. And if we continue to see a movement into the medium term moving averages, into the longer term moving averages, the S&P 500 ultimately will have to go higher. And even here in technology, things are looking very robust. And if tech is looking robust and the broader market is looking robust, the only thing the S&P 500 can do is move higher, make higher highs, new all-time highs, and that just means more money to you if you're holding equities. Now, let's dive into some macro. Looking at US rail traffic, this is for week 27, 2024. You see some very interesting developments. Not much has changed since last week. We can see that year-to-date rail traffic is up 8.6% in total intermodal units, up 2.3% in total traffic. And when you look at all of this, look at coal, right? Down 17%, and we're still up for the year. So these are very, very strong figures. And if you actually look at the cumulative carloads and the average per week, coal is the biggest by far. So to actually see this figure positive on the year with the decline we've seen in coal, very, very strong rail traffic, and often a huge parameter for the consumer and what consumer data is going to look like in a couple of weeks. So strong rail traffic data right here often bodes for stronger data down the line. Now, at the same time, financial stress, this is the financial stress index, is at all-time lows. You can see here below the zero line is lower stress, above is quite high, and we're sitting at low levels of financial stress despite the recent hiking cycle the US has gone through, and this has resulted in liquidity conditions staying fairly bid up here in the US and definitely in the Eurozone. You can see that we've definitely been above the bid zone for quite some time, and the second we do get below it, we shoot right back up. And if you actually want to see a prolonged slowdown in the equity markets, what you really want to see is sort of like a move below the bid zone here in the liquidity conditions. And as long as we're in the bid zone for both the Eurozone and the United States, liquidity is a net positive for the financial markets. Now, looking at relative sector performance versus the S&P 500, we can see some very interesting developments. Just a couple of weeks ago, the only two sectors that were outperforming the S&P 500 was the information tech sector and the comm services sector. Now it's still looking fairly grim, but you want to look at the developments. You can see in stuff like energy, industrials, materials, real estate, healthcare, utilities. You can see like sort of a change right here in relative performance of these sectors against the S&P 500. And then in stuff like technology, they move lower. And this is clearly showcasing the rotation we're starting to see. We can see it here, true. We can see it here as well in financials. So the market definitely broadening out. What we do want to see now is, for example, in something like the real estate sector, we want to see continued movement to the upside, breaking some of these key levels. And if that were to happen, we could say the rotation is clearly underway. Now, looking at data next week, guys, so we have a fairly light week of data. The big thing is actually just going to be retail sales here on Tuesday, and then retail sales minus autos. And then we have a couple of other key reports coming on Wednesday and Thursday. We have the US leading economic indicators, so consumer confidence, the family stress index, initial jobless claims, as well as housing starts and building permits. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.